You're losing because you're trading noise, not setups, not opportunities. Noise. The 5-minute chart shows you every panic sell, every algorithm spike, every random tick that means absolutely nothing for the actual direction of the market. It feels like information. It feels like you're seeing more, understanding more, catching moves faster. But you're not. You're watching chaos pretend to be structure, and chaos doesn't pay. I learned this the hard way. I spent 2 years glued to lower time frames, 5-minute, 15-minute, 1 minute sometimes when I was really convinced I could catch the perfect entry. I studied every candle. I analyzed every wick. I thought I was being thorough. I thought more data meant better decisions. I was wrong. Those 2 years cost me more money than I want to admit, not because I didn't know how to read charts, but because I was reading the wrong charts. The day I switched to higher time frames, everything changed. Not my strategy, not my risk management, just my perspective. And that perspective shift took me from break even to consistently profitable in 3 months. I learned that mastering lower time frames without mastering higher time frames is meaningless, and this awareness is an awareness every trader needs to experience. Let's begin. Let me show you why higher time frames always win. And I mean always. This isn't preference. This isn't style. This is mathematical reality. Lower time frames lie. Higher time frames tell the truth. And if you want to make money in this game, you need to understand the difference. Imagine you're standing next to a river. If you focus on one spot right in front of you, you'll see water swirling in different directions. Little eddies going backward, currents moving sideways, splashes that seem random. If you only looked at that one spot, you might think the river doesn't have a direction. You might think it's just chaos. But step back. Look at the whole river from above. Suddenly, the direction is obvious. The river is flowing one way. All those little swirls and eddies are just surface disturbances. They don't change the fact that the river itself is moving in one clear direction. That's the difference between lower and higher time frames. The higher time frame can give you a clear idea of which direction to trade. The lower time frame gives you the opportunity to find a better entry for that trade. But if you only move according to the lower time frame, you might be looking for positions against the higher time frame. And if you're doing that, no matter how clean the trade looks on paper, you're very likely to get stopped out because you're trying to swim against the current. That's exactly what's happening. The 5-minute chart is you staring at that one spot. Every candle feels significant. Every reversal feels like a trend change. Every spike feels like an opportunity. But it's not. It's just surface noise within a larger structure. The daily chart is you stepping back and seeing the whole river. The direction becomes obvious. The noise disappears. The trade becomes clear. Here's what most traders don't understand. More information doesn't make you more informed. Past a certain point, more data just creates more confusion. You start seeing patterns that aren't there. You start reacting to moves that don't matter. You overtrade because every tick feels like it's telling you something. But most ticks aren't telling you anything. They're just random fluctuations within a larger trend. And if you're trading those fluctuations, you're gambling, not trading. Market makers know most people drown in lower time frames only. That's exactly why lower time frames are actually more manipulative. Higher time frames are more consistent. If you determine direction according to the higher time frame and try to operate your strategy only in that direction, your win rate will increase significantly. And this isn't rocket science. It's actually very clear straight logic. And it works. Trying to find direction on lower time frames without mastering the higher time frame is leaving your work to chance. I remember the exact trade that made this click for me. I was watching a stock on the 5-minute chart. Beautiful breakout pattern, volume spike. Everything looked perfect. I entered long. 3 minutes later, it reversed, stopped me out for a $50 loss. I was frustrated. The setup was textbook. So I pulled up the daily chart, something I rarely did back then because I thought daily was too slow, too boring. And there it was, clear as day, a massive resistance level right where I'd entered. The daily chart was screaming, "Don't go long here." But I never looked. I was so focused on the 5-minute noise that I missed the daily structure. That $50 loss taught me more than any winning trade ever did, because it showed me that I wasn't losing because I couldn't read charts. I was losing because I was reading the wrong time frame. Looking for a trade against the daily chart made no sense at all. It was no coincidence that potential long setups were forming for scalp traders who had no idea about the daily chart at that exact moment. The market maker was easily hunting traders who had no knowledge of the higher time frame. That's exactly what was happening. Here's the brutal truth. When you trade lower time frames, you're not trading the market. You're trading other traders' panic. You're trading algorithms fighting each other. You're trading noise created by people who don't know what they're doing. The 5-minute chart reflects emotional decisions. The daily chart reflects structural movement. Emotional decisions are random. Structural movement is predictable. Which one do you think is easier to profit from? Let me give you a specific example. There's a trader I know. Smart guy, experienced. He was trading breakouts on the 15-minute chart. His win rate was around 48%. He was barely break even after commissions, frustrated, burned out, ready to quit. I told him to try the same strategy on the daily chart, same setups, same rules, just different time frame. He resisted at first. Daily felt too slow. He thought he'd miss opportunities, but he tried it. 3 months later, his win rate was 53%. Not a huge jump, but his average winner went from $80 to $320. His average loser stayed the same. Why? Because daily chart moves have follow-through. When a daily chart breaks out, it's not random. Institutional money is moving. Real capital making real decisions. These moves continue. They have momentum. They have structure. They have clarity. Institutions don't find it logical to trade on 5-minute charts like we do. Because of the position sizes they want to take, this stops being logical. So you can see their footprints on higher time frames, not on 5-minute charts. There's no problem with trading on lower time frames. The problem is trading on lower time frames without any knowledge of the higher time frame, looking for entry on the 15-minute candle while having no idea what the 1-hour or 4-hour candle you're inside looks like. This makes no sense at all. I recommend your strategy must include a higher time frame confirmation. This will significantly increase your win rate. Let's continue with examples. 15-minute breakouts, half of them are false. They're caused by algos, by day traders chasing, by people who don't have conviction. These moves don't continue. They reverse as soon as the pressure stops. So even when you're right on the 15-minute chart, you don't make much. But when you're right on the daily chart, you make real money, because the move is real. That's the difference. And this is why every professional trader I know operates on higher time frames. Not because they're smarter, not because they have better strategies, but because they understand that structure only exists on higher time frames. On lower time frames, you're trading noise. On higher time frames, you're trading the actual market. And the actual market is what pays you. And the higher time frame also makes it possible for you to open larger positions more comfortably. Don't trade on lower time frames if you don't yet know how to read the higher time frame. Find ways to use the higher time frame and lower time frame in a correlated way. Here's another thing most traders miss. Lower time frames create psychological torture. You're watching every tick, every candle. Every small move against you feels like disaster. Every small move in your favor tempts you to take profit early. You're in a constant state of emotional reaction. That reaction kills your edge. You can't make good decisions when you're reacting to every fluctuation. Higher time frames remove that torture. You take the trade on the daily chart, you set your stop, you set your target, and then you walk away. You check once or twice a day. That's it. No tick-by-tick stress, no constant second guessing, no emotional roller coaster. You've made your decision based on structure. Now you're just waiting for the structure to play out. This mental clarity is worth more than any strategy, because stress destroys discipline, and discipline is what separates winners from losers. You're much more likely to execute a trade taken on the higher time frame consistently. The probability of your discipline breaking is much lower, but as you slide to lower time frames, these possibilities strengthen. But here's the trap. Lower time frames feel productive, you're busy, you're active, you're taking trades, you're doing something. Higher time frames feel boring, you're waiting, you're watching, you're not trading much. And for most people, that boredom feels wrong. It feels like you're missing opportunities, like you're being lazy, like you're not really trading. This is the psychological trap that keeps 95% of traders stuck on lower time frames. They can't handle the boredom of doing nothing. So they drop down to the 5-minute chart where there's always something happening, always a setup forming, always a reason to trade. And they lose money. Slowly, consistently, because they're trading noise, not setups. The 5-minute chart really meets all your criteria and looks almost textbook, but at that moment, the 1-hour chart is in such bad shape that it actually tells very clearly what will happen. Yet you're moving with the 5-minute and can't understand how you got stopped out. The answer is simple. The higher time frame dominates the lower time frame, and what the higher time frame says happens. That's it. Let me tell you what happened when I finally committed to higher time frames. I went from taking 15 trades a week to taking 3. My screen time went from 8 hours a day to 2. My stress went from constant to almost 0. And my account? It grew more in 6 months than it had in the previous 2 years combined. Not because I found a better strategy, but because I stopped fighting noise and started trading structure. I stopped reacting to every move and started responding to moves that mattered. The market didn't change. I changed. My perspective changed. And that changed everything. Moreover, if you really have a mechanical strategy, you can apply it to any time frame. Changing time frames doesn't mean you can't use your strategy. Change your strategy to a version suitable for the higher time frame, and start trading on the higher time frame right away. If you want, also trade the lower time frame on the side. Observe how each one concludes, how each one makes you feel. Then decide for yourself. Here's the framework I wish someone had given me 2 years earlier. If you're day trading or scalping, you need to understand something. You're not trading the market. You're trading order flow. And order flow on lower time frames is heavily influenced by algorithms, retail panic, and random noise. Unless you're an institutional trader with direct market access and sophisticated tools, you're at a massive disadvantage. You're playing a game you can't win. Now, if you're swing trading or position trading, you're trading structure. You're trading where institutions are positioned, where real money is moving. And that information is visible on higher time frames, daily, weekly, monthly. These time frames filter out the noise. They show you what actually matters. Not only that, trading on the higher time frame also means more time. You have more time to make decisions. The probability of missing an opportunity is much lower because opportunities don't vanish in seconds. Everything happens more slowly, so you manage better. You can continue thinking rationally. You free yourself from the burden of making decisions within seconds. Thanks to all this, you have a more stable psychology. You experience less stress. So everything affects each other positively, and your life is affected positively in the same way. You're walking on a more sustainable path. You're creating less pressure for yourself. All of this strengthens your hand and works in your favor in terms of being a profitable trader and maintaining it. But most people want to take trades more frequently, to look at screens more, to be more involved in this game. But usually these desires lead not to being a profitable trader, but to being a break-even or losing trader with a worn-down psychology. The problem is choosing paths that make this already difficult game more difficult rather than easier. Don't do this. Try and see. Decide for yourself. Here's my rule now. I only trade daily charts and above. I check the weekly for overall context. I check the daily for entry and exit. I never look at anything below the 4-hour. And even the 4-hour is rare. This single decision removed probably 70% of my losing trades, because those trades were never real setups. They were noise that looked like setups on lower time frames. But when you zoom out, they disappear. They become irrelevant. The setups that remain, the ones visible on the daily chart, those are the real opportunities, and those are the only ones worth taking. Most traders do the opposite. They find a setup on the daily chart. Then they drop down to the 15-minute to find the perfect entry. And that's where they get killed, because the 15-minute will show you 10 reasons not to take the trade. 10 little reversals. 10 moments of doubt. And you'll talk yourself out of a good daily setup because the 15-minute scared you. Don't do this. If the daily chart says go, you go. The lower time frame noise doesn't matter. It's distraction. Always care more about what the higher time frame shows. Don't let the lower time frame influence you. Here's what I want you to do. Pull up any market you trade. Look at the 5-minute chart for the last week. Count how many setups you see. Now look at the daily chart for the same period. Count the setups there. The 5-minute will have dozens. The daily will have maybe 3. Now here's the question. Which 3 daily setups do you think worked better than the average of all those 5-minute setups? I'll tell you. The daily setups worked better, not because they're magic, but because they're trading structure instead of noise. They have follow-through. They have momentum. They have real money behind them. This is why higher time frames always win. Always. No exceptions. If you're struggling to be consistent, if you're tired of getting whipped around, if you feel like the market is hunting your stops, you're probably trading too low of a time frame. The solution isn't a better strategy. It's a better perspective. Trade the time frame where structure exists, where noise is filtered out, where moves have meaning. I know what you're thinking. But if I trade higher time frames, I'll miss opportunities. I'll be sitting around doing nothing most of the time. Yes, exactly. That's the point. You should be doing nothing most of the time. Trading isn't about being busy, it's about being selective. The best traders I know take maybe 5 to 10 trades a month. That's it. They're not constantly active. They're waiting for the high probability setups, the setups visible on higher time frames, the setups that actually matter. And when those setups appear, they go big. They have conviction, because the structure supports them. Compare that to the trader taking 50 trades a month on the 5-minute chart. Always busy, always stressed, always losing a little here, making a little there, never building real equity, just churning their account while brokers get rich on commissions. Here's the final truth. The market rewards patience. It punishes activity. Lower time frames encourage activity. They make you feel like you need to trade, like you're missing out if you don't. Higher time frames encourage patience. They make it obvious when there's nothing to do. And when there is something to do, it's clear. Obvious. No question. That's the difference. That's why higher time frames always win. If you want to be consistently profitable, if you want to build real wealth through trading, you need to make this shift. Stop trading noise. Start trading structure. Stop watching every tick. Start watching the daily chart. Stop reacting to every move. Start responding to moves that matter. The market will always be here. Opportunities will always exist. But your capital is finite. Your time is finite. Your mental energy is finite. Stop wasting those resources on lower time frame noise. Invest them in higher time frame structure. That's where the real money is made. That's where professionals operate. And that's where you need to be if you're serious about this. Higher time frames always win, not sometimes. Always. Make the shift. Your account will thank you.